Hoi luisteraar, ik ben Erik van Compliance Adviseert en heb een leuke mededeling. Studiecentrum Kerkenbos, de opleider op het gebied van fraude, opsporing en compliance, komt met iets bijzonders. Als luisteraar van deze podcast krijg je met de code Compliance100 maar liefst €100 korting op een fraudecursus naar keuze. Bijvoorbeeld over witwassen, financieel recht, fraudeonderzoeken en gegevensuitwisseling bij fraudebestrijding. Profiteren? Ga naar www.kerkenbos.nl, Kerkenbos schrijf je met CK in het midden en SCH op het eind, en gebruik de kortingscode Compliance100.
Compliance. We just need your compliance.
Je luistert naar Compliance Adviseert. Deskundigen vertellen over compliance en integriteit bij Nederlandse financiële instellingen.
We just need your compliance.
Credit card acquirers and credit card issuers need to comply with laws applicable to all payment institutions. But processing credit card payments on behalf of merchants or issuing credit cards to consumers requires additional compliance. Compliance with credit card scheme rules. Rules imposed by Mastercard, Visa, Diners and other credit card schemes. And yes, this can be an additional responsibility for compliance professionals. Understanding these scheme rules and ensuring the acquirer or issuer complies with these rules. Let's find out what that means in practice. Simone Aurighi has a broad experience in the payment industry. He started his career in 2007 in the UK at First Data Corporation and had subsequently several roles as head of risk and roles in supervisory boards of several payment institutions, including European Merchant Services, PayU, Mastercard, after which he became a consultant, and some of his clients are Payment Sense, Molly and BitSafe. Now he's willing to tell us more about credit card schemes. And we're very happy to have you in the podcast, Simone.
Hi, Eric. Thank you. I'm very happy to be here as well.
What do you recall as the most impactful experience in the payment industry? Something you'll never forget and that taught you a lot?
Yeah, if I go back to my early years, the possibility to experience the payment function as a service to existing banks has been something that really helped me to form my view about payments and to learn a lot about them without being specialized into a single bank. I started my career with First Data Corporation indeed, and back then they were providing many different payment services to a large number of different banks. And it was, I call it the University of Payments for me, because it was really a great way to learn a lot about how payment works in different markets and in different institutions. Because
and what did you learn about that?
That it's different everywhere. There is no one-fits-all measure, because the beauty of payments is that they really need to be tailored to the consumers, to the markets where they operate. And so what I was doing for the Italian bank was different from what we had to do for the UK bank, which was completely different from what the American banks were doing back in the US, because First Data used to be, today's Fiserv, they are an American-centric company, but they were providing services all over the world in different markets. And so you learn very quickly that it's not the same for everyone. You really have to be specialized to have a solution for the market and the consumers where you operate.
What is your experience with the risk and compliance profession?
Yeah, I've been spending more than 15 years now in risk, and I always worked with compliance as my sparring partner. Compliance, even when I was at European Merchant Services, I had a very good colleague that we always worked together in compliance and risk, and we were called the dynamic duo, because we were working together in a way that we would support the business and the commercial area to be compliant and not take too many risks, but still being able to deliver a good service to our clients and being able to achieve our revenue targets, because obviously we are running a business.
How would you characterize the difference between the risk and the compliance profession?
Yeah, One thing that I always say as the key difference between risk and compliance is that for risk, it needs to be 90% good, whereas for compliance, it has to be 100% good. The importance for me is to strike the right balance between the two. 100% compliance is difficult to achieve, and it could be sometimes in certain companies, this is refers to as business prevention office, the compliance function, because if you make it too rigid, it becomes very difficult to drive business through the organization. And then risk is there to be a bit of a balance factor to the compliance factor. I'm not saying that organizations should not be compliant, but I'm saying that sometimes certain compliance requirement can be overlooked if the risks attached to it are not too high. And so the two, risk and compliance, should always work in a healthy dynamic where the risks of non-compliance are fully understood, and this is then transferred to the management board of the organization where you're working, and the management board can make an informed decision to either take or not take a certain risk, to apply or not apply a certain compliance requirement.
And where does scheme compliance land? At the risk desk or at the compliance desk?
Yeah, with car scheme compliance is a bit of a different dimension, because obviously compliance with law and regulation should never be compromised, whereas car scheme compliance, it's a form of regulatory framework that is business driven. So it is imposed by a private company to the entire industry. And as such, it never prevails local law. So local law is always taking the precedence, and local law should always be respected. Whereas with car scheme compliance, because it's driven by a business perspective, it can be overruled by business itself, as long as the business is ready to take certain risk. If you think about some of the players in the market that disrupted the market, the first rules that they actually went against were car scheme compliance. If we look back at 10 years ago when Adviseert was starting, they were trying to break the rule that every merchant had to be registered with a particular acquirer, whereas they were coming into play and wanted the contract to be with them and not with the acquirer. They wanted to play the role of the middleman between the acquiring bank and the merchant. Certain acquirers did not agree with that because it was against car scheme compliance back then. Others did, and then Adviseert became who they are today, because they were ready to take the risk and still manage it in a way that did not brought bigger risks other than just breaking the scheme rules. Exactly, yes.
They will probably also have reached out towards the schemes to explain why they could take that risk.
Without a doubt, yeah. So there are other examples in the history. So also back then, money bookers was another player around at the same time. They were fined significantly by the car schemes back then for breaching car scheme rules. And then it all went back to the intention that the player had. If you were breaching the car scheme rules to take advantage of the system, then obviously that didn't really play well with the market and the industry. Whereas if you were trying to bring a better service to clients, merchants, and consumers in general, then you would have had it easier, let's say, because you were actually bringing more value than taking advantage and then just making value for yourself.
That already says something about scheme rules indeed. It's not a law, it's a business-driven rule. What do we need to know about the way Mastercard, Visa and other credit card schemes work to understand the compliance part of it?
So it is important to remember that indeed they are businesses as well. They are stock listed, so their driver is shareholder value. So they will try to make as much money as possible, like most players in this space. Card scheme rules sometimes are applied to defend that value. It is, for instance, back in the years, there was the area of use, which is still in place as a card scheme rules, where certain players cannot operate within market where they are not licensed or where they are not registered. At the very beginning, this rule was set up to protect the banks. So if I was a bank in a specific country and I didn't want other banks or other players to enter my market, they had area of use rules so that nobody could provide acquiring services or issuing services in the same market that I was as a bank. This has eventually, with the advent of e-commerce and that broke down the barriers of traditional countries,
Borders,
and so it was easier to provide the service from other countries and other jurisdictions, and that had an effect on the entire industry, moving away from the brick and mortar into e-commerce. The area of use rules became a bit more, they became harder to impose, and it was also less justifiable to provide a specific service to somebody in a certain country.
Which was different from another country.
Yes, exactly. Yeah. And this, I have to say, it helped. The fact that the area of use rules were less strong than they used to be in the past allowed the e-commerce market to boom, actually, because then good players could provide better services to merchants that otherwise would have been left with poorer services offered by local players.
Mm-hmm. Yeah, that's one of the bigger developments in the payments scheme world, I think.
Yeah.
Can you take us briefly through the history of credit cards?
Yeah, it starts very much back in the 60s, I believe, in California, where I don't recall now if it was Bank of America or another American bank.
I think it was.
It was Bank of America, wasn't it? Yeah, that started providing. There were a lot of merchants, or let's say businesses, that would provide credit to their clients. And so if you were a butcher, you would have a book. You would take note of people that would buy meat from you but not pay you. And so you would extend credit. And this type of business, I mean, it was normal even when I was a kid back in Italy. When I was going to buy bread for my grandmother, she would say, "Oh, just tell them to write it down," and then
we'll see when we
and then eventually she would pay the bill at the end of the week or at the end of the month. And so many businesses back then were used to extend credit to consumers, also because it was a very local service. This was a time where every small business knew exactly who their client were and where they lived. Mm-hmm. And so they were able to give credit because you will see the person every day or every week. What the banks did, went into these businesses and said, okay, if you want to have this removed, because it becomes difficult to manage, it's you need first of all to keep record of it, keep books. It's a risk if people then don't pay. So if you want to have this removed, I can take that away from you and I can manage your credit book for you. Yeah. And that is where the whole idea of providing credit cards started. It then evolved into what we see today, but it took a long time. So this was obviously done at the beginning as a service from a bank to local businesses. It then also became more convenient for consumers themselves, because then all of a sudden I was recognized in any shop that would accept a specific card or a specific brand, and not just my local butcher or my local restaurant, let's say. Yeah. So this evolved into a service that was very beneficial for both sides, the merchant side and the consumer side. And it continued to grow as a service that many banks would provide. And then we got to the stage where companies like First Data indeed started taking this service away from the banks, because then all of a sudden it was no longer, because then like everything we grew, the industry grew to a point where the bank did not have a viable solution for this anymore, because it was easy to manage until it was on a smaller scale. But then the power was indeed on being able to have the card accepted in as many locations as possible.
In your story till now, you said the bank. Is that the same as Mastercard, Visa? Are they banks?
They are not banks today, for sure.
No.
So that is where, also Mastercard and Visa grew out of. So they were providing certain services, and then they became
A business
a
on
business
their own.
on their own.
Yeah.
And even today, they are completely different than what they were 40, 50 years ago. Because it's, even the names are different. But the evolution was to remove themselves from the actual process and push it down to other players. And so First Data was providing services to banks and the schemes themselves to be able to operate a system that would have not existed without the technology offered at the time by First Data itself.
So First Data back then was actually really a technology-driven
Yes.
business.
Yeah,
Okay.
yeah. They were creating systems for different banks and outsourcing their services so that you could white label a credit card, for instance, or you could white label a merchant service
And probably
operation.
process a lot of
Yeah. When I
transactions.
started with them in 2007, when we were doing the induction, we were told that 1 transaction in 3 in the world was processed by First Data and by the banks affiliated with First Data. And we had 28,000 people in the company at the time. The funny thing was always, when I first started, I would say that I worked for a credit card company, and everybody was asking if it was Mastercard or Visa. I always say, no, you don't really know how it works in the background, because there is a complete, there is a word behind that makes it work. Today you just touch the card on the terminal or on a phone or whatever, and it just works.
But is that created by First Data or by Mastercard, Visa?
Yeah, no. So back then, First Data created the technology allowed by the rules that were implied. So with the birth of e-commerce, it became harder and harder for players like First Data or the traditional banks to provide a service that was fitting the e-commerce needs, and more players were born that were even more technologically advanced, so that you could operate in the internet and offer services in real time to anybody, anywhere in the world. And that's why companies like Adyen or like Molly today, other e-commerce providers, have been so successful, because the adoption of technology continues to increase, and it's difficult to keep up with the evolution, both on the technology side and also on the industry. Because
if you started in 2007, you will have a legacy, and other companies can develop new technology.
Back then we were still processing payments on paper slips. So some, if you remember those, some clients, some merchants will send in an envelope with paper slips that were just. That's why the numbers on the cards used to be.
Stands out,
stand out, because then people could use the paper to get the number on the paper, and then you would process. We had an operation team who would key these paper slips into a system, because almost everybody had moved to an online service. But some players still wanted to use the old-fashioned. It's like with everything with evolution, there are some early adopters and some very late ones.
I understand. When did the separation between acquirers and issuers? What are their roles?
Yeah, it is. I believe it happened very, very early on, because it's two sides of the same medal, but they are very much different between themselves. On one side, you cannot have one without the other one. First of all, that's why they are two sides of the same thing. But you have the issuers, who are the ones that actually take the highest risk. That's why issuers tend to make more money as well than acquirers, because on the issuing side, you control the consumer side. And so you offer credit to individuals that want to spend money. This was historically the highest risk, because it was very difficult to have information about people. You would need to know them, and that's why usually it used to be banks, because you would offer a credit card to somebody that was already your bank client, and so you would know how much salary they had, how much the mortgage was, and all the payments going in and out, and so it would be easier for the bank to establish how much credit they could extend to these individuals. It moved away from that as well. Here in the Netherlands, it's typical to have ICS. ICS used to be, to me, at the time when I started, the only issuer not linked to a bank back then. Today is part of ABN AMRO. I don't know if at the time it was ABN AMRO still. It's not a bank giving you the credit card like it's most common in other countries. So, for instance, when I was in the UK, my credit card was given to me by the HSBC, which was my bank. The same in Italy. You would always get the credit card from the bank, and you wouldn't obtain it from a different institution.
No, that was quite remarkable about the Dutch situation.
Yeah. The Netherlands have the privilege of being one of the most advanced payment industries in the world. I have to say, I was very lucky to move here 12 years ago because with regards to innovation, technology, and adoption of non-cash payments, this was the best place where to learn about it. And I do think we are very, very lucky here to have a very solid and so mature system of paying. Ideal itself is a way of payment that was one of the first ones in the world for what it does and how it does it well. Like everything, then, you become a bit too much complicit. How do you say that because you are so successful, then you tend to hold on to the success that you have instead of continuing to innovate. So Ideal now, it's being challenged a bit, and I know there is Ideal 2.0 coming out, and so that is also evolving. But if you think about it, it went on for more than 10 years to be one of the key drivers of the evolution of e-commerce here in the Netherlands.
Yes.
Even though it provided less guarantees to the consumers compared to credit cards, because the beauty about credit cards is that your purchase is always guaranteed to you. If you buy something that is not delivered, then you can ask the money back from your credit card company. You cannot do the same with Ideal. Once you send the money, the money is gone.
Sure.
But that is playing to a very peculiar Dutch trade of not spending money that you don't have. So with Ideal, you always pay out of your own pocket, whereas with a credit card, you tend to pay out of money that you still don't have.
Interesting. These kind of developments are mostly driven by cultural differences, isn't it?
Yeah, that is why I was saying at the beginning that
those different
markets play in the payments are very peculiar to the markets where they are born, and some of the peculiarities are driven by the culture of the population. Like, for instance, then I went on to, because I worked primarily on credit card acquirings in Western Europe and the US markets. So I was very familiar with the Western payment systems. And then when I went to PayU in 2014, I started working a lot more with emerging markets. And then you realize how different it is in other markets. So, for instance, in Brazil, you would have boleto, which was one of the most popular ways of paying, but it still meant you had to download a form, go to a shop, pay at a shop with cash, and then it's something that here in the Netherlands it would have never worked because it would be just too complex and too difficult to make, whereas it was one of the most popular payment methods there compared to the normal industry. And another difference with the South American markets was also the acquirers, they pay out at 30 days. A merchant. So to
30 days.
30 days,
You have to wait for your payments.
So the payments are processed today, but then the disbursement of the funds is done a month later because they want the acquirers themselves. This was back, a few years back, but then there was not really much of a trust between the merchants and the acquirers themselves. So the acquirers were processing the payments, and then the money would only be paid out once the service was given. Whereas here in Europe, especially, I mean, now today with the regulations that we have in place, everybody is obliged to pay next day, and you cannot really hold on to the funds unless you have a specific reason, because there is fraud happening or because there are certain risks attached to it, but you cannot keep the money for yourself. The money are the money
You
of
have
the
to
merchant.
pay to the
you
merchant.
have to pay to the merchant, yes.
I see. Well, those are some cultural differences. That's interesting. And we have a better idea of, better understanding of what issuers do. They issue the cards to the consumers.
Yeah.
Can you tell us more about the role of the acquirer? You already mentioned the name.
Yeah. That is indeed the other side of the coin. And the acquirer, which is my entire experience, I always work on the acquiring side. The acquirer provides the services to the merchants. So any website or any shop where you want to buy something, it's then registered with an acquirer for them to be able to accept credit cards, authorize and clear the payments through the systems, and then the acquirer collects all of these funds and pays them out to the merchant. The risk on the acquiring side is that the financial risk is attached to the fact that all these payments are guaranteed for the consumers. And so whenever the merchant is not delivering the service, each one of us, when we buy something with a credit card, if we order a laptop online and the laptop never arrives, and then we try to call the shop where we bought it and nobody answers the phone, we can go to the bank, to our issuing bank, and ask for the money back. The issuing bank gives us back the money because we never received the goods, and goes to the acquirer and asks the money from the acquirer.
The issuer goes to the acquirer.
The issuer goes to the acquirer. The acquirer gives the money back to the issuer, and then the acquirer goes to the merchant. If the merchant is there,
communication challenges.
It works very well when everything is done through reliable parties. But then obviously there are some instances where somebody will just set up a shop. There are two major cases. Either somebody set up a shop to defraud people, but then if you did buy with a credit card, you're still guaranteed, and so you will get the money back as a consumer. And at that point, who's left to pay the bill is the acquirer, because the acquirer didn't do a good job in recognizing that the merchant was a fraudster, because it's their responsibility. Just like the issuer will lose the money on the consumer if the consumer doesn't pay the credit card bill.
Those are the main risks for the acquirers and the
issuer. It's the financial risk.
Yeah.
Then obviously you have all the risks linked to compliance, with integrity.
But we were first going through the financial risk.
Financial risk, yeah.
And understanding the world of the compliance. Why did they choose to... I assume that Mastercard or Visa or the schemes decided to have acquirers and issuers working for them.
Well, the beauty of the system is that they pull themselves out of the equation eventually. So they are only there to guarantee. So they act as a referee. Because they provide the licenses to acquirer and issuers, they guarantee that the acquirer is operating to a certain standard, and the issuer as well, that they all follow the rules, that they all provide a standard service across the world. And they are paid for that, but they don't actually play that big of a role in the processing part. A completely different thing is American Express. American Express is different from Mastercard and Visa.
How?
Because they always are in between the acquirer and the issuer. So the acquiring services are guaranteed by American Express itself, and the issuing services are guaranteed by them also. So whereas with Mastercard and Visa, there is a complete split between the two areas, and Visa and Mastercard provide the brand. That's why they call themselves brands. They are just branding the service provided by somebody else. In the case of American Express, it's a closed loop. So an acquirer and an issuer for Visa and Mastercard will never know what the same information that is. So the acquirer doesn't know the information of the issuer and vice versa. Whereas with the Amex, because it's a closed loop, it is a much more controllable system, and it comes with a higher cost because it's harder to put it in place, and it's but yeah, I would say for a consumer it actually is probably a better service if it works properly as expected.
Would it also make it easier for a compliance professional to comply to Amex rules compared to Mastercard and Visa rules? Because Mastercard, American Express is already near to these payments. And
with Amex, as long as you process for them, then the risk and the liability is always assumed by the other, so by Amex itself and not by the players involved. Similar to Amex is what PayPal brought along, because PayPal ended up creating a similar system where they had a closed loop solution between merchants and consumers, because you had to register with PayPal and then you would use your normal cards or other forms of payments eventually to process a payment through PayPal, and PayPal would have your information shared as well with the merchant and create a closed loop environment just like Amex did.
But in my opinion, PayPal is a wallet, a payment wallet.
Yeah. It started like that.
Amex is not the same.
No. It's not the same, but it conceptually is the same as a closed loop solution, whereas Visa and Mastercard are different because they are an open loop is not closed. Whereas
each payment is a closed loop, you mean, with Amex. Whereas if you compare it to Mastercard, you just use your card issued by your issuer, but you can pay at any acquirer
that accepts Visa.
Yes,
or Mastercard.
That's the difference.
Yes, indeed.
I think I understand.
Okay.
Thank you. How do scheme rules, because now we're going to talk about the compliance perspective and not really the risk anymore. I think we've explained how the world of schemes and credit cards look, isn't it? Did you want to add something to that?
No, I think we covered more than enough. Yeah. It's,
how do scheme rules protect us? And I mean consumers.
From a financial point of view, a consumer is always guaranteed a purchase.
And that's also because of the scheme rules.
Yes, the scheme rules mandate that, and it's that is why personally I would always pay with a credit card and not with Ideal or a bank transfer or my debit card.
Not worried that your credit card details are stolen and that someone else pays with your credit card details?
No, because that is also always guaranteed. You're always protected from fraud. Unless you give your credentials away to somebody, because obviously that is a different story, because it's difficult to prove if you were collusive or not. But then, for instance, the 3D secure password or the one-time token that is become more popular now are ways to make sure that you are the person that is supposed to make that payment. In the past, people could just have your credit card number and use it on your behalf. Still, you were guaranteed, if you went to your bank saying, I did not make that purchase, you would be refunded your money.
Okay.
Yeah, anyway. Obviously, like any insurance, you can only do it. I mean, if you go every time complaining, then obviously that raises suspects. But then if you are a legitimate consumer and it happens that your credentials were stolen, you would be guaranteed against fraud and not have to pay the bill.
I still sometimes pay with credit card online. I just have to enter that 3 code on the other side of the credit card, and there is no. Is that 3D secure?
No. That was one of the first security measures put in place, so that you had to physically have the card with you because the number was at the back. That's CVV or CVC. CVC and CVV. The other 2 card schemes call them differently. So it was placed at the back of the card, because then if somebody had a payslip, the ones that I mentioned a bit earlier about just having the credit card number, they could have processed a payment. Whereas with the additional 3 digits at the back, processor was sure that you actually had the card with you, because you could only see the back of it if you had the card. Otherwise, with a paper slip, you wouldn't be able.
I see. If you steal credit card details online, then you don't have that CVC code, and then
because it's never
it.
stored for PCI.
Yes.
So that was never stored. But then even if somebody took a picture of the card, you could still have the number, but you didn't have the number at the back. So that was one of the first way to protect. Then 3D Secure happened, and it was the password. This was one password that you would set up with your own issuer, and then whenever you were doing a purchase online, you were asked to enter also this password. And this was normal throughout, about 10 years ago, it was quite normal. Then with the advent of smartphones, then it became easier and easier to do that one-time password. So you will get a token every time, a different code to enter to authorize your transaction, still to be protected from fraud. And today, most of them, especially here in the Netherlands, they do it with the app. So if you have a Visa card or a Mastercard from ICS, you would have the ICS app that will make you authorize the transaction yourself directly from
on
the
your
app,
phone.
on your phone.
So you need your phone to make a payment to make it really safe.
Yeah. All of this is made to protect them against fraud. That's the thing, is the issue. So they are making it a bit harder for the consumer, but it's becoming easier and easier. I mean, it was difficult to remember a password, and a lot of payments were failing because people didn't remember the passwords. Today, most of the time, is just a biometric signal. So either your thumb or your face would authorize the transaction. So it's easy also for the consumer, and it guarantees the issuer that is really the consumer making the payment. So fraud becomes harder, and even if your details are stolen, you're still guaranteed. The additional protection that you receive is then the one that I was saying earlier about you buy a ticket with an airline, and then the airline goes out of business. Or, Air Berlin went out of business a few years ago, and other airlines went out in the past. Or indeed, you buy a laptop and the company never sends it to you, and you cannot receive the money back from the merchant. Your bank will always give you the money back. And that is a guarantee that you have with no other payment methods, really.
Actually, the system is quite secure already, and still you have that guarantee. What you already said, it's mainly to protect the issuer themselves, because they...
on the fraud side, for sure.
Yes,
on the fraud side, all the challenges that you receive as a consumer when you want to make a payment, they are simply to make sure that you are who you say you are, which obviously for you it's very true, but then it is still a digital signal received by an issuer to make sure that it's really coming from you. They are creating all the different mechanisms.
I understand, yes. From the point of view of the acquirer, what processes for accepting clients are in place, and what do the rules require?
The most basic requirement is that it needs to be a legitimate business. Whatever service you are selling, it needs to be compliant with any local law. There are then some additional restrictions in place which are driven by card scheme rules. The Netherlands has always been a bit of a tricky country for the card schemes, because certain things that are legal here are not legal in other countries. And so the card scheme rules tend to be more stringent in those cases. If you think about prostitution or soft drugs, these are mostly not legal in most of the countries except for the Netherlands. And so the card scheme rules will still consider them as not allowed in their systems. Even though there is an argument that they are legal here, it becomes very difficult to process payments for this type of services. The main requirement is that the business is a legitimate business offering legal services. There are, for instance, one of the main rules to be aware of when processing for merchants is the BREM violation. So these violations are
The brand violation?
BRAM, B-R-A-M.
Okay. Yeah.
I don't remember what the acronym stands for,
But it is B-R-A, not E,
M.
M. Okay. Yeah.
BRAM violations, which are services that people are not allowed to sell on the credit card systems. And these are, so it started with child pornography. Child pornography was a big problem 20 years ago or so, 15 years ago.
It's still a problem, but not for the card schemes
sorry.
anymore.
Yeah, I didn't mean it in that way.
I
Obviously,
understand.
yeah.
I understand.
So, child pornography was one of the things with the advent of e-commerce. It became easier to buy and sell online, and then credit cards were being used for this type of services. So a lot of effort went into try to remove completely this type of sales from the credit card schemes. Then drugs is another key violation. Illegal gambling, because gambling was made, online gambling was made illegal in the US in the 2000s, and a lot of people still wanted to gamble online, and so there were a lot of websites starting up to offer illegal services for gamblers, and that was also a business not allowed. And then we go down to, for instance, counterfeit goods. You cannot sell replicas of fashion. For instance, you cannot sell a Gucci bag that is not a Gucci bag for 20 euros. That is prohibited by the card schemes, and they will actively monitor the websites that do sell this type of goods.
So acquirers are required to check on these goods. If businesses are in this type of businesses, then they are not allowed.
Yes.
Is there also a risk, a balancing act there? Or
because like everything, it's how difficult do you then make it for all the good merchants? The challenge is to make the system as safe as possible for everybody, with rules and processes in place that prevent bad players from taking advantage of the system. And it works the same way on the issuing side and on the acquiring side. The challenge is to make it as difficult as possible for the bad ones, but still as easy as possible for the good ones.
That's a challenge everywhere.
Yeah,
in my
indeed.
opinion.
It is. And it applies to payments. And so that's why, the password at the beginning on the consumer side, it was a good way to prevent fraud, but then it was making it very difficult for individuals to be able to process payments. The same goes on the acquiring side. If you want to onboard a merchant, there are a number of rules that the merchant needs to comply with, and there are a number of checks that have to be made on the website, for instance, by the acquirer. But then the imposition can be on the merchant to provide this information, or the acquirer can try to source the information from providers that are there to sell this information or to make checks on the website and on the companies that are coming on board. Then the more stringent these checks are, the more difficult it is for the merchant to obtain an account. And so the balance there needs to be found in a way that we still make it difficult for the bad ones, but easy enough for the good ones to obtain an account.
I see.
It's the same. I applied for insurance the other day. It was very difficult. They asked so many questions because I think so many people tried to scam the insurance. So you go through a process that it becomes very hard for you if your intentions are good, because they are trying to stop all the ones that are applying for the wrong reasons.
I see. Okay. Yeah. What integrity risks, like money laundering, should be definitely taken into account when assessing integrity risks with credit cards as an acquirer?
Yeah. So
what I'm really looking for is there a money laundering risk with credit cards from the perspective of the acquirer?
There is very much.
Tell us about it.
So money laundering, that's the whole purpose, is try to reprocess money through the system so that they look legitimate. I think it's much easier to do it with cash than with online payments or card payments. And so until we will have cash, we will have a money laundering problem, and the easiest way to move away from it is to make all cashless payment as traceable as possible. And so that is a good way to try to move away from money laundering. The problem obviously doesn't simply go away. It just becomes harder to do. And so what we have seen in the industry on the acquiring side is that merchants would set up fake shops or even legitimate shops that then they use to process payments through it. It still comes through a credit card. So even the money going into the credit card is it's channeled through the payment system in a way that leaves a trace, but then it becomes hard to find it. It's like finding a needle on the haystack.
There is a stash of criminal obtained money.
Yes.
How do you go about if you want to money launder that?
Yeah, you create a legitimate way of registering that money into the system. And so you create a fake shop that generates a certain volume of money going through that justifies you to have an amount of cash that you wouldn't otherwise have.
But then you have to make payments to your own shop, for example, illegally obtained money.
What we have seen, one of the businesses where I worked, we had a number of businesses, of companies that were all doing the same thing. They were all selling the same product. This was candies. And the strange thing that we picked up on was that every single month they had a very similar amount of money going through, and they were also the different shops, I think it was 4 or 5 different shops, all of them processed right about the same amount of money, which looked very, very strange because you would expect a bit of fluctuation into the system. And also the question was, okay, who's actually buying all of these candies for this amount of money? And it didn't really make any sense.
Was it the physical shops? Or
physical shops.
Physical shops.
These were physical shops. It was not an online service. And so it becomes also harder to check because online, everything is traceable and everything leaves a mark. Also on the physical one, but then, the physical one, it depends how the transactions are put through the terminal. It could be done... I'm not that much of an expert, but I think there are ways also to push payments in a certain way. Because the system is built to process payment from one person to another one. And it's built in a way to make it very easy to do that. And then there are different criminals and ill-intent players that find different way to exploit a system in a way that nobody ever thought about it before. And that's why fraud and money laundering are constantly evolving. My job, what I'm doing today, is not what I used to do 5 years ago or 10 years ago, and it keeps on changing. It becomes very, very difficult to be on top of it. And whenever you see something new, you then go about and try to make sure that it's not replicable and it's not done again.
Because this example is not really specific for credit card acquirers, in my opinion. Any bank, shop. Any shop can... but what is quite specific about credit card schemes is also the prepaid card, for example. I'm not sure if we can still use it. I never used it, but it's some kind of a gift card, let's say, because you can buy it without having to tell anyone that you are who you are, and then you can spend money. What is the reason? Why are there even prepaid credit cards, and how do you regard the risk with the integrity risk, and how do card schemes fight crime committed with prepaid credit cards?
The prepaid cards were born out of a need of the market, actually. So, for instance, it would be, at the beginning, it would be given by parents to children so that they had a certain amount of money that they could spend. Or even in Italy, it's quite common to have prepaid cards because a lot of consumers don't trust the system. Again, they are afraid of their details being stolen. And so they prefer to use a prepaid card where if you just put 200 euros on the card, that's the maximum amount that you will lose, rather than your normal credit card where people might be able to process up to 2,000-3,000 euros.
Maybe it can even be a way to make sure you don't spend too much.
Yeah. So there are plenty of legitimate reasons to have it.
I understand.
Then obviously it can be heavily misused because then some of them are anonymous. It's just prepaid. You don't know how the money went into the card and where the money is spent somehow, which is why also one of the most regulated line of businesses from the acquirer point of view is vouchers. Vouchers is a way of transferring value without knowing where that will be used. And so
vouchers, is that comparable to prepaid cards?
Technically, yes, because you are simply putting money from your credit card onto another way of transporting value that it is used wherever the voucher is accepted. The prepaid card would just be accepted everywhere that Visa and Mastercard are accepted, but the voucher is then being used at a specific location or shop. We had an example with one of the acquirers where I was working. We had this company doing online vouchers, because one thing is the physical voucher, still you need to buy it and use it, but nowadays there is these e-vouchers where you move money from your credit card into an e-voucher, and then that voucher can be used to whatever purpose without linking it back to the credit card. And that is something that we have seen being used, for instance, to do illegal gambling. We had a merchant that was selling, all of a sudden they were selling e-vouchers. It was a merchant based in Europe, but all the vouchers that they were selling, they were being bought in Turkey. And then it looked strange for this merchant to only be selling in Turkey. And then we started investigating into it, and we found out that this e-voucher could be used to gamble online, which is illegal in Turkey. And so consumers in Turkey that wanted to have this service, they were obviously buying these e-vouchers to process payments that they were not supposed to. And this is where it makes it very difficult to catch them as well, because when the fraudsters is trying to defraud the consumers, then you have many signals that point into a problem. So somebody doesn't receive the goods, or somebody is being taken advantage of, and so
they will complain.
Exactly. Yeah. You'd start getting complaints, and then you identify. But when the buyer and the seller are actually collusive because they both want what it cannot be done, then it becomes harder and harder to identify them. So for instance, I had example of illegal music, illegal downloads. People would want to buy, this is before Spotify and all the other streaming services that came, but people wanted to buy and download songs that they were not supposed to, and so they would buy services like this. Another example is people buying cannabis seeds. If they want to buy them, they will never complain about receiving them. And so how do you go about as an acquirer identifying a merchant that is selling?
Can it also be a transaction monitoring rule? We didn't receive any complaints about this merchant.
That usually is, it is a sign, especially for certain type of industries where you would expect a number of refunds or chargebacks or complaints. You would then address the fact that they have zero and start looking into it. Obviously, you prioritize the ones where the complaints are, but then also, when it's too good to be true, there is also a reason to look into it.
You told me the schemes are mostly tough on the prohibited sectors, the business sectors, like online gambling and stuff like that. Are they also very tough on money laundering?
Yes, I mean, because laws always take the precedence, and so they will never allow and facilitate any illegal activity. And because money laundering is very much an illegal activity, they would prioritize that, as an area of focus for both the acquirer and the issuer, because also the issuer needs to be careful of where the payments for the expenditures on the cars are coming from. So, for instance, to have my credit card, I need to provide my pay slip and apply for it and justify the way I'm able to generate enough funds to cover my expenditure as a consumer. The same applies to the acquiring side. Certain businesses sometimes simply don't make any sense, and then we are obliged to investigate it and make sure that the merchant is not conducting any illegal activity.
Do the scheme rules have additional rules against money laundering compared to the laws that are already the European and American laws against money laundering? Or do they just say you have to comply with the laws?
Yeah, to my knowledge, there's nothing stricter than the existing rules. But the existing rules are already quite strict. It's just, the challenge there is that it's difficult. I have to say that throughout my career, I've seen a lot of instances where, money laundering, because one thing is money laundering from illegal activity, but even tax evasion can be considered a way of, it's not really money laundering and you're not laundering your money, but you are trying to avoid to display or to make people aware of your incomes and your the origin of your funds because you want to pay less taxes, and that is also a way of breaking the law with the new regulations that are coming along.
That's true, yeah.
And it's you've seen the Panama Papers and all of that. It's
but then we went from prepaid cards to vouchers previously, and this actually means that the schemes may also not have additional rules to make sure the prepaid cards are used in a legal way because the laws itself are imposed already.
Yeah, so what is mandated there is to make sure that the system is not abused. So also for vouchers, so prepaid cards, but I think it's easier the example of the vouchers. There are certain rules and regulations that the voucher provider needs to oblige with that make sure that those vouchers are not used for any illegal reason. The same applies to prepaid cards. You cannot use a prepaid card to buy drugs or to process illegal money. But
there is still a risk that my illegally obtained money, I buy prepaid cards and I can still spend it. If I don't spend it on drugs, then I don't have any problem with the credit card schemes.
If you're not caught, no, that's the problem. But that is, it's like if you buy a kitchen knife at IKEA and you kill somebody, is IKEA responsible for that? I understand. So the service is provided to facilitate good business. For sure, the schemes and all the players involved do their utmost to make sure that the system is not abused. But bad people are bad people.
And what ways do schemes have to make sure the acquirer and the issuer comply with these rules?
Fines, and fines. It's it's the easiest way to give a financial penalty.
But how much information? Where do they get the information to detect non-compliance?
So, for instance, the example I gave earlier about illegal downloads, they will go around and test cards on certain website that they know they're not legitimate to see who's processing that transaction. The example of illegal downloads came from Visa at the time. It was Visa. They found a website where people could download music without having the rights to that music. They received some complaints from the music industry and they then they processed a transaction and they realized it was our acquiring business processing that transaction. So they came to us and they said, okay, look, that website is actually doing illegal activity because we did a test transaction with them and we recognize that they are doing an illegal download. So this is a way they monitor, but still it came from a specific complaint that they received, and then they act upon it, and then they went to
so as an acquirer, you can only hope that the complaints will go to you instead of to the
it's so even for that there are businesses around that provide services to scan and monitor the websites to make sure that the website is not doing any illegal activity. So every single acquirer is mandated to have one of these providers in place that would verify on a regular basis that the website is selling legitimate services and goods.
Right.
And if there is any non-compliant, it will be flagged to the acquirer. Then the acquirer needs to investigate and it needs to justify why a certain transaction is happening. But it goes even beyond that. Today, they got so good at it, the bad guys, that the website might look legitimate and they might even have a legitimate presence, but then they push through the same website transactions that are coming through a completely different website as well. But they are able, with the technology that they have, they are able to rechannel this transaction and look it as if it's coming from the right website. And that is called transaction laundering. Like similar to money laundering, the transaction laundering is the idea of having an illegal transaction that cannot be processed, pushed through a legal business.
So that legal business isn't really aware of what
yeah. It's either aware or not, but then it's possible both ways, and the transaction then is processed with a belief that is to for a legitimate use. It's a game where you play to make it as hard as possible for the bad guys,
misuse,
and not too difficult for the good ones.
What is your opinion about credit card scheme rules in general and the way these rules are supervised by the schemes?
My opinion is that the card scheme rules have been created with the right intentions to be sure that the system is as good as possible for the consumers and as reliable and trustworthy as possible. So there is no doubt that the whole apparatus of the card scheme rules is there to make it work in a way that everybody can enjoy the services provided by a card payment without taking too much risk on the self, both on the issuing side and also on the acquiring side. There are certain rules that are there mostly to protect the system, but there are also other rules that are there to protect the players. If you think back...
the players, then you mean the consumers or the acquirers and issuers?
The acquirers and issuers, and as well the schemes themselves. Themselves.
Yeah.
If you think when the European Union wanted to reduce the cost of card payments, there was a lot of lobby going in from the industry to try to avoid that, because they wanted to cap the merchant service fees to 0.2% and 0.3% for different type of payments.
Because these fees are quite high compared to Ideal, for example.
Yes, yeah. Ideal is just a transfer of value without any check, technically speaking. So that not completely true. So obviously they check that the money comes from a certain place or going to another, but there is no guarantee attached from it. So as I said earlier, you will lose your money once you pay with Ideal. Whereas on the card side, there is the whole guarantee that needs to be provided to the consumer, that it's obviously costly, and that is covered by the merchant fees.
So if you are using your card because you don't want to have any risk, you will be paid back if you don't get your products.
Yeah,
you're actually transferring the risk to the merchant, isn't it?
Yes, to the players behind, for sure.
If the cost, merchant,
and the cost, the cost will always be taken by the merchant, but then the merchant is simply charging it back to you as the consumer. If you're buying a laptop that costs 800 euros, you will probably pay 805 to cover the cost as well. The business needs to be profitable, and so any cost that they have will be then transferred down to the consumer. So it's always the consumer paying. It's like insurances, the insurance system works in a way where you pay a premium. If a lot of people are abusing the system, then the premium goes higher and higher. Yeah. And here is the same. The good thing with card schemes and the cost of it is that it has become so popular and so spread that it really is now companies have very low margins. They make basis points, not even percentage points anymore. But there are so many payments going through that because of the technology, it's much easier and easier to process them. And so
Less costs.
the costs go down per transaction for sure. Yeah.
My last question.
Yeah.
Do you have any good compliance advice for our listeners?
Yes. So what I would say is to always look behind the rule itself. So whenever you are confronted with a rule that you need to apply and to follow, my recommendation would always look at the intention of the rule. So don't just follow the rule because it's there and because you have to, but do the very Dutch thing of asking why. When I moved to the Netherlands, I always was asked why I was requiring a certain process or anything that I wanted. My Dutch colleague would always ask me why. Why do you want to do this? Why do you want to have this? And so I would simply turn that around to anybody here, that is working in the compliance field. Make sure that you understand what the intention of the rule is, and make sure that you still apply that, even if you are not following the rule by the book.
Exactly. Yeah. Thank you very much, Simone Aurighi.
Thank you, Eric.
It was a pleasure having you in the podcast and explaining the scheme rules world. Thank you.
Thank you. My pleasure.
Compliance. We just need your compliance.
Dank dat je luisterde naar deze podcast. Volg onze LinkedIn-pagina en kijk op onze website complianceadviseert.nl. Heel graag tot de volgende podcast.
We just need your compliance.